Hello everyone. Today we are going to talk about a topic that confuses almost every beginner investor: stocks, bonds, and mutual funds. You may have heard these terms many times, but do you really know the differences? Where is the risk higher and which one should you actually invest in? Don't worry, I will explain everything in simple language with real life examples. So let's get started. The stocks, also called shares, represent ownership in a company. When you buy a company's share, you are essentially buying a small piece of that company. For example, imagine Reliance has 100 crore shares and you buy one share. That means you are now a shareholder, technically a small owner of the company. What kind of benefit will you get if you buy shares? See, if the company makes a profit, you may receive dividend. And if the share price increases, then you gain capital appreciation. But what kind of risks will you get if you buy shares? If the company performs badly or the share price falls, you lose money. If you buy stocks, then will you get ownership plus high risks plus high return. Second is, what are bonds? Think of them as a loan you give to a company or to the government. In return, they promise to pay you have a fixed interest regularly. For example, suppose the government issues a bond worth 1 lakh rupees at 7% interest. If you invest, you will get 7,000 every year as fixed income, no matter how the stocks market ups and down. And at the end of the maturity period, you will get your 1 lakh rupees back. But what kind of benefit will you get? See, you get fixed income and it is relatively safe compared to the stocks. But what kind of the risks will you get? See, returns are usually lower than stocks and inflation may reduce the real value of your money. Third is, what are mutual funds? Mutual funds are like a basket that can contain both stocks and bonds. Instead of buying shares directly, you give your money to a professional fund manager who invests it on your behalf. For example, imagine you have only 2000 rupees. With this amount, you can't buy shares of multiple companies like Reliance, Infosys, and HDFC Bank individually. But if you invest that 2000 rupees in a mutual fund, your money is pooled with thousands of other investors. Together, the fund manager build a portfolio of 40-50 companies. What kind of benefit will you get? See, first benefit is diversification. Your risks get spread across many investments plus professional management. What kind of risks will you get? See, the returns go up and down with the market and there are fund management charges. If this video helped you, now based on your financial goals and risk appetite, you can decide where you want to invest. If this video helped you, don't forget to hit the like button, share it with your friends and subscribe to the channel for more such simple financial stories. And I will see you in the next video with another exciting topic.